Hey everybody, what's up? We are back with another portfolio update. So I know I just did one a couple days ago, but everything has been going so well that I figured I would make another update. Also, some changes to the portfolio. I made 2 sells, which don't normally do. I haven't sold anything in a while, probably since Sarence was at $26 a share. But yeah, I made 2 sells. I sold a couple shares of Hims and then about a third of my position in Supermicro. Now, once again, this does not have any indication of my confidence in the companies. It's mostly just de-risking positions that have appreciated more than I expected them to, and those include Supermicro and Hims. So I'll go into both of those in a moment. But anyway, make sure to subscribe if this is your first time watching. And yeah, that's about it. So let's get into the portfolio. So looking at the overall stats here, we can see up year to date almost 12%. It was actually above 12% this morning, but I am assuming if we head on over here to not the channel statistics, but the actual trading view watch list and we go over here, I'm sure a couple of things are a bit lower now. So Supermicro was up like 14%. That's down now a bit. Celsius, I think, was up more, possibly. I'm not entirely sure, but we could possibly look at the 1-day charts here actually and just see what everything is doing, which we will do now, as I am not prepared entirely for the video, but we're going to see how everything is doing today. So that is not right. There we go. All right. So biggest thing dragging the portfolio is Hims is now down. I think they were up slightly this morning, possibly, maybe not. Other than that, we are still up on the day overall by a pretty decent amount. Leader of the day, though, which is fairly shocking. Oh, this is not today, is it? Oh, yeah, it is. Wait, 18th. Yeah. Oh, it is. Okay. I didn't even know what time it was. Hims, or no, sorry, Supermicro was up a lot more, as we can kind of see over here. Now they are up 3.25%. Dollar General is kind of leading the pack today in terms of being up, which is pretty rare for them recently. So looking into some things here, first of all, one thing I would like to point out right away is I put $100 more into each of my ETFs. That is mostly from profits from SMCI and HIMS, where I did sell about 10 shares of Supermicro and then 3 shares of HIMS. Again, that is mostly just because I had so much of them. So Supermicro is now at 5.25 or 5.5% of my portfolio. It was at like 7%, I think, just about, which is essentially the same size as all of my ETFs. So if you see here, it was basically the same size as all of my ETFs, which is fine for the most part. But overall, I really don't want any individual stocks to be that much unless I'm down on them, which is the case with Celsius, as we can see here, where I do have a fairly comparable amount. One stock that I am not going to be de-risking anytime soon is Chewy, just because they've been performing so well, which we can get into here. So Chewy has just been so consistently up since I bought them that I just don't really see the point in selling. I feel like there's so much more growth that can happen here, and they've just been in a very strong uptrend. So I'm not going to mess with it. If it goes up another 10% or so, I would probably sell a little bit. But for right now, I'm holding what I have because why not? Other than that, everything else is mostly the same. I don't think I made any other changes. I don't remember if I said or not, but I did double my position of performance shipping, which to be fair was only like $50 and now it's $100. But they do have earnings coming up very soon, which I am incredibly interested in. I'm very excited to see what happens there. If it goes down, whatever. If not, it could be pretty solid. Based on my own valuation of them, I think they should be worth a lot more. And that is moving into something now that we will get into is valuations. I did actually update them this time. So everything here is updated as best as I could. Some of the smaller companies like GMM and Performance Shipping and Not really Cerence, actually. Cerence just has negative EPS. Anything that says NA here just means they have negative EPS, and the valuation really doesn't work very well for that company. But getting into it, Celsius is now much closer to fair value based on their sector compared to where they were. Chewy is currently 25% upside. And I should probably put upside slash downside here, which I'll just update really quick. Chewy is at a 25% upside, Dollar General 75%, Lululemon at 34%, which they have also been performing exceptionally recently. Robinhood is about 20% or 19 and a third percent overvalued currently, which is kind of to be expected with how much they've grown recently. However, I also believe that their earnings will very easily make up for that. Probably within the next quarter or two, just based on how they've been growing. And we'll have to see either way. But PayPal, 82% upside. That is probably one of the ones I believe in the most. That Dollar General makes a lot of sense. Crocs as well, I feel like is also very undervalued, which you can see here, 287% upside is crazy. But realistically, they just have a very low EPS or PE ratio. And seeing that, I'm honestly expecting a lot of growth from Crocs. I don't know how much I actually have in them right now. So currently, I have 4 shares. And the thing is, for me, at least personally, it is hard for me to buy companies that I'm up on. And Crocs, what I didn't even notice this because it's just not one of my. It wasn't what my primary focus was on, but there was a fantastic buying opportunity for Crocs just a couple days ago that I completely missed. I would have loved to get in at $90 a share, but unfortunately I didn't. And then they had that really, really good earnings report that sent them up 24% in a day. And now here we are. But I would say if it reaches the $100 mark, I would probably buy maybe 1 or 2 more shares. But for right now, just because of where it is, also breaking the long-term support that they saw is a little concerning, but at the same time, they jumped right back up into it, and they also had excellent earnings. So in my opinion there, it's perfectly fine, but a little bit of uncertainty just breaking the long-term support, but I think they are mostly fine now. Um, Other than that, looking at the rest of the valuations, GMM and PSHG are a little bit unique in where it is really hard to find a reasonable amount of competitors for them because they are such small companies. The ones that I did find put them at being extremely undervalued, which honestly, for both of these companies, I fully understand. If we just go into GMM really quickly, I will show you exactly why. Now, again, I don't know, I'm not an expert on these companies, but this company currently has a $13 million market cap, and they put away 40 million in sales just last year. They also have positive net income. Their net income from last year is equal to their market cap, almost slightly below their market cap. When you see multiples like that, at least in my opinion, I just think it's insane. So I reasonably expect this company to be a very easy 1-200% within the next year or two, as long as there's not something insane going on here, which from what I understand there isn't, but at the same time there could be, and I'm just stupid and don't know about it. But just based on the financials and kind of what I've seen, there is a ton of upside here, and not the craziest amount of downside, at least in my opinion. I think they are up today as well, which we can just look up really quickly. So this is one thing with them. Their chart is very concerning. Used to be much, much, much higher than it is now. One thing I have been noticing is kind of the curve here, which if you check out my friend's channel over at Dumpster Dive Trades, he trades based on these kind of movements a lot. But for me, at least, I usually don't, but I kind of just saw the pattern here of it curving upwards, and I hope that's what happens. We'll kind of see. But overall, they are up slightly today. So either way, not too bad. And also with companies like this, I feel like it is risky, but there's also so much potential upside of being such a small company that you could put in $100, $500 or so and not have the craziest amount of risk because it's such a low amount of money, but the potential that you could make from that small investment is a ton. For example, my original investment in Cerence on this account. I had invested in them in the past and sold, but my investment on this account was 70 shares at like 299 average. So I put in 250-ish dollars, and I think it's worth, I mean, I know it's worth well over that now. Let's just check really quick. It's currently worth $800. It was worth around 1400 at one point, but I sold some shares, and also it is just lower than it was at its peak. But it was worth much, much more than it is now. And actually, thinking about it, I had 70 shares at $26 a share. So if we just do that math right here, it was worth 1,800 at one point, um, which is crazy. And that was from roughly a $250 original investment. So I would say that putting small amounts into these high risk but noticeable potential companies like GMM, where there's a ton of sales growth and they have a lot of net income, actually, a lot more than some other companies. Is definitely worth the risk. If I lose the $100, it would suck, but at the same time, it's $100, and the potential for it could be getting into the thousands, possibly, considering it's such a low market cap. When I invested in Cerence, I think its market cap was around 100 million. It's now at, I think, 500 million. So GMM is at 13 million right now. If that reaches 500 million, it would be insane, um, to say the least. So that's all I really have for that. Valuations, again, P Lab is also very undervalued, which is based on actual solid competitor results. So that is another thing. That's one of the reasons I invested in them as well, is just because they look pretty good. That is another one where I don't have a lot in them at all. I put about $100 in. Should I see either better performance, or let me just go in here. If they go any lower than they are, I would definitely consider buying more. There's a very long-term support range here that they've been following, fairly reasonably. They've been following it, and just seeing that if we go to like the 20-ish dollar range, I would probably consider buying more. Honestly, might fairly soon, just because of the potential we've been seeing. I mean, they had that huge run up to right around $30 a share just a couple weeks ago, and that was after their really solid earnings report. So if this next one is anything similar to that, we'll probably see it hit that $30 mark again. And if we do, I probably want to be the one that invested more in them. But for right now, I'm not going to, but possibly in a couple days I will. Um, Other than that, let's get into the dividend portfolio. So, looking in here, we saw another week of fairly solid performance. Total dividend was just under $6. The weekly yield was 0.6. The total performance was 1.8%. So we are very close to actually breaking even here. And I think once that happens, it'll be a little bit of a snowball effect where the share reinvestments and yeah, that's about it. The reinvestments into it will kind of start taking over and building more equity in this. Um, but honestly, I don't know if I want to continue doing it too long. I think I'm just going to break even and then sell it off. But we'll see what happens. If I start to notice some actual momentum building there, I think I'll just keep it. But definitely an interesting experiment. I would say it was worth the time just to learn about asset value decay at the very least. But overall, I'd say medium amount of success, but either way, not too bad. Um, Other than that, I think that's all I want to go over today. So thank you so much for watching. Make sure to subscribe if you haven't, and I will see everybody in the next video.